Right, hi there and welcome to the business edition of PM Express with me, Philip Nanfuri. On tonight's chopping board, we're going to look at the domestic bond market, and we titled this one, Bond Battles and Blues, the 20-year bond controversy. But is it really a controversy? Last week, there was a story from Bloomberg that reported that government failed to meet its 20-year bond target of 450 million Ghana cedis. And this week, we've had a response from the Ministry of Finance indicating that this was not an inability, this was not a failure, this was not a flop, and it was a shelf offering. What does that mean? What fancy technical jargon is that? So essentially, government says to the Ministry of Finance that this 450 million target, they were able to get 162, and it wasn't like they were going to get all the 450 million at once from the market. So we want to explore this, and I have very interesting guests. These are inside players when it comes to issuance of debt in the country or issuance of bonds, etc. But before we get into all the discussions, I want us to look at a number of infographics we've prepared. The first one has to do with the domestic debt market, and by that I mean who actually lends money to government or who borrows from government. And I put together data from the Central Securities Depository of both government securities and private sector debt. So it's an aggregation of the players in the industry. You'll find a number of interesting names there. Then we'll look at external debt, where we borrow from out of the shores of Ghana. Then we'll come down to the issuance calendar. That's more or less government's Bible when it comes to how much they want to borrow over a period of time. So let's start with the domestic debt and look at the players in the Ghanaian market and how much each of them is holding in terms of debt in the Ghanaian economy. Right, so the first infograph just shows us how much players in the financial market contribute to both government borrowing and private sector borrowing. So you've seen that the Bank of Ghana, you've seen commercial banks, you've seen foreign investors, you've seen pension funds. Now what these players do is to mobilize money from you and I, our deposits, our pension contributions, etc., and buy these securities from government. So if government goes and says, I need a 182-day treasury bill, I need a 365, I need a 2-year note, I need a bond. These players are the ones who actually have the money. And you can see in there that commercial banks actually are holding 31 billion Ghana cedis worth. You see foreign investors matching up to that with 27 billion, and you see pension funds doing about 8 billion. So all these players, as you see on the left-hand side, are the main lenders to government and to the private sector. So anytime we talk about debt, government borrowing within the country, domestic, these are the people that contribute and help government to raise money for a variety of purposes, recurrent, capital expenditure, etc. So that's just a snapshot of the players on the left, and on the right, we have the amount they are contributing or they are holding. And you can see that commercial banks are the biggest players there, followed by the foreign investors, then the pension funds, and then we have SNIT even there, insurance companies, etc. Rural banks, all these are players. Now, that's for the domestic side. Let's go to the external side and see what we can learn there. Right, so that's external debt, and external debt beyond the shores of Ghana. So anytime government goes to borrow, we are borrowing beyond Ghana. And we've seen the multilateral creditors, bilateral creditors, international capital markets. Let me just explain some. So multilateral creditors, we have the IMF, we have the World Bank, we have the AFDB, that's the African Development Bank. They are the multilateral creditors. Multi-index connotes ability to lend all over, or pulling of funds from all over and lending to people all over. Then we look at bilateral, that's on a country-to-country basis, sometimes through agencies of a country. So I'm sure you've heard of DFID, you've heard of JICA, you've heard of USAID. All these are bilateral agencies of countries such as America, the UK, etc. Then we have the international capital markets. When you hear the finance minister talking about bonds, Euro bonds, he goes for it from the international capital markets. And you see the figure there, it's about 4.9 billion as at end 2018. And this is data from the Bank of Ghana Statistical Bulletin. And you see something like commercial creditors. These are the international banks. So we have your HSBC, you have your Standard Chartered, PLC, etc. All these are places where government accesses funds from. And you can see as at the end of 2018, in US dollars, the total we've borrowed or taken from these external sources is 17 billion. So we've looked at domestic first infograph, external second infograph. Now let's look at the issuance calendar. What tells us how much exactly government plans to borrow for a quarter? It's divided into 4 quarters. I'm showing you the third quarter one. Just take a look at this. Right, so if you look in the right corner, you see 20-year, you see the 450 million, that is the bone of contention for our discussion tonight. But just to feed you some information from one of my guests, if you look at the 5-year, government planned to raise a total of 250 million, but they got over 600 million Ghana cedis. Now, if you look at the 10-year side, they plan to raise 300 million, and they got a little over 500 million. Not a little, but it's way up there in terms of. So these two, for the 5-year and for the 10-year, essentially they've gotten more from the markets than they even anticipated. So one of my guests argues that this 450, them not reaching that amount, is not really a big deal because there is appetite for government debt in the market. So yeah, so that's it for the issuance calendar, just to show us how much government projects to raise from the markets and then how much they want to get. So my guests, 2 interesting gentlemen, like I said. First one, Samson Akligo. He's the Acting Director, Financial Sector Division of the Ministry of Finance. And then to his left, Sam Eidu is the Deputy Managing Director, Wholesale Banking, Fidelity Bank, Ghana, one of the indigenous banks still in the system after we had the biggest shake-up ever. So they are going to walk us through the nuances and the intricacies of government borrowing from the market. Samson, coming from the Ministry of Finance, will speak to government's role in all this. And some coming from the private sector, and I'm sure you've heard the word joint book runners, book building before. I'm sure George Rafi in his reports on radio keeps on throwing those words at you. Joint book runners, book building. Tonight we're going to get the education on all that. So Samson will do that for us from the government side of things, and Sam will do that for us from the private sector side of things. So just stay tuned and then let's get the education. But I want to start with Samson on this whole 20-year issue. So this bond was issued. The target was 450, and 162 was raised in the market. there was a story from Bloomberg that said we didn't meet all that 450, and there was a comparison between Ghana and Rwanda. And now the Ministry of Finance has come out with a statement telling us essentially that this was a shelf offering. In layman's terms, square this for us, because the understanding seems to be a bit lost. We see 450 million there as a target. If you go through the issuance calendar, you see that it says the 10, 15, 20-year bonds will be shelf offerings, but a news item says we didn't meet the target. So put this into perspective for us.
Thank you, Philip. I think that your introduction really gives us the perspective from which we should have this conversation. If you look at what we have been doing over the past 2 years, you see that the strategy for our debt management has been well laid out. And the pillars of that strategy is very important for us to understand everything that, that is even leading to this conversation. And I'll break it down. I mean, you said we should break it down, so I'll do my best to break it down. So the first pillar, which is very important, is that how does a ministry borrow money? I mean, the financial requirement is done at the most efficient and best possible way, based on the context from which we started from. The first one is that your interest rate, or maybe if I reverse it to maybe a market jargon, the pricing of whatever debt you raise must be done in a very, very competitive way. The second thing is that we have to solve a very important problem for the country, whereby historically we are borrowing heavily in the short term and 91 days and maybe 182 days and then 364 days. And then thirdly, a lot of the issuances that we're doing were not benchmarked. It's very important to put that in context. Now, when you are managing an economy, be your revenue expenditure, you always have residuals. The financing comes into the residuals. So you make a projection that in every quarter, this is how much money I need to borrow in order to support my expenses. And as you rightly put in context, so in the quarter that we have said that clearly, how much we're going to borrow. And if you look at June, we've gone, for example, we issued a 10-year bond, and then we went to the market. In our indicative figure, we said we wanted 300 million. You go to the market, and from what you have said, we have raised over 600 million. You go again to the subsequent month, that is July. You said you're looking for a 15-year of 300 million. Again, the market has given over 500. Then you are going to the market again in August. You said you want to raise 450 million. Most importantly, the total that you need for that quarter is your 10.35 million. Now, let's now come to this controversial 450. I think that the slant of the reportage was very, very unfortunate, especially when it came from Bloomberg. Because when you are doing a big building approach, and the strategy that I've outlined earlier, and this, you raise money, you even, in your first issuance, it's in SS, in the second one in July it's also in SS, and you are coming to your 20-year. And this 20-year, we put a lot of thought into this 20-year. This is the first time we are doing a 20-year. We're doing that because we have a strategy to extend the yield curve.
And then by yield curve?
Yes, for example, as at 2016, the highest number of years that government borrows, so you can borrow for 10 years, you can borrow short term today. In 91 days, you have to pay back. You can borrow for 1 year and pay back, but you can also borrow over a long term, which also have I will go into the mechanics when you ask me, but I want to go back to the 20 years. So we are saying that we have an objective to lending the yield curve, and I'll tell you the reason why it is so important for us to do that. So when you're doing that for the first time, and luckily for us, we put a thought into it by making sure that that is the last one that you are issuing. So when you go to borrow, and you've even raised SS, and you have announced to the market that is a shelf offering, what you do is that with your advisors is that they will guide you. That look, you are issuing a new instrument, you have a yield curve, you have to price it very well. Understand? So we have given them a guidance as to what we are expecting. They've gone to the market, and the market is not. The market says that based on your guidance, this is how much the book runners were able to generate. You cannot describe that as like maybe a flop. It's very sensational, because the book building approach is like the price guidance is a market clearing mechanism. If government in whatever way says that I want to get my 450 million, all that you have to do is to send a signal that makes you to get that. But we are very mindful about the interest cost and what we are doing over time. So the foundation of the argument in saying that this has flopped, unfortunately, is not true. And that is what we sought to correct. I don't know whether you want me to extend it to even the most the most painful one that even confirms that, even based after the first one that it was being said that this thing has flopped, then you have gone ahead to compare us to
Rwanda.
Rwanda. And everybody knows. Basic finance tells you that if you want to do such comparison, there's a way that is done. It's standardized. You see, you can't just take, why do economists, for example, if you say Ghana's growth is this. You don't use nominal growth to compare countries. You have to do adjustment to standardize it. Now, you've done the second level of your analysis says that we have gone to issue the bond at 20.2. And then Rwanda has gone to issue the bond at about 13.6. And then you are saying that even though we issued the bond at 20.2, investors has shown our, maybe our bond and have rather gone to do Rwanda. That is the most interesting aspect. The truth is that the pricing that we have determined as like for our country is what you have to look at. So we have determined a pricing of 20.1. If you look at our inflation rate, for example, and you look at the real interest rate that investors will actually make on this bond, you realize that our real interest rate is lower than that of Rwanda. So if you even open the bond up, and maybe I'm an investment or the banker buy the portfolio, and I see a real interest rate this, and I say, oh, these people are tightening the spread. These people are widening the spread. And typically, if you look at those countries' rating, you can decide to go here. But we are doing that because we believe in the confidence of the macro economy and the fact that the expectations that should guide investors putting money in this is more firmer. So these really are is the contest, that we have to look. And I think that is very, it's really unfortunate. It's not true.
You made mention of a lot of fancy words. Book running, joint runners, book building. Sam, before I get to the question of the process government goes through in raising money from the market, as you are a player in facilitating that process, what I want to find out from you first, before you explain that, these terms, the book building, the joint runners, etc., can you simplify it for us, please?
I see. Thank you very much. We'll try and give it a shot. I think essentially what you need to do as a government or as an entity looking to raise money, you need professional advice. You need people who are involved in this on a day-to-day basis. So what typically large borrowers do is engage the services of either a lead manager or book runners in our case. So the government put out for a number of banks to pitch for the role as book runners. And at the end of the sort of beauty contest, there were a couple of banks picked, 3 banks in fact, and then 2 non-bank institutions. So the 5 of us are the local book runners for government. Now we have a tenure, prior to this was for 2 years, and now we have a tenure for 3 years. Now, so this is our job description. Our job description is to help government on a weekly basis or on a monthly basis achieve their plans they've set in their program for the year to try and meet their borrowing. So what will government do? Government will look at all the expenditure items it has. It looks at all the revenues it comes in. It has a net number of what a forecast of the debt or funding they would need. I do that at home. I look at my pay that comes in. I look at what I need to pay school fees, and then I can tell that maybe this month I'll be this short and so on and so forth. So government does the same thing. And what government does is engages us through putting out a program of what they expect us to raise on a quarterly basis. So we have indeed, as you showed, the program government gave us to raise money from a period, for a 3-month period up to August. Now, so government says, I want to raise for 91 days this amount, for 182 days this amount, and for the various instruments. Now, government doesn't get this information from other documents they put out. It comes out of their net domestic financing. So government has a systematic plan on a 3-year basis, on an annual basis, on a quarterly basis, what their funding requirements are. And then they come to us as professionals to say, help us raise this funding from the market. So what do? We engage government on a periodic basis and say, this is the task that we have to do today as book runners. So we'll call investors. And you pointed out the investors in government securities. It's essentially institutional clients, retail investors, and then also offshore investors. So your institutional clients, you showed a couple of them. These could be banks, this could be pension funds, this could be insurance companies, and then the retail market like yourself, myself, our parents, our uncle and auntie. So all these look to buy the investments or the investment opportunities that government will present to them. So we run this program, government gives us what we should be looking out for, and then we go and try and execute it. So it's a well thought through program. It's a program where we have specific activities that we get ourselves involved in. So for instance, if we have an auction next week, this Friday we will put out the announcement to the market to say we are required to raise X amount of funding, and it's going to be in these securities or the other. Then we put out this information by Friday. Then what we tend to do is that by Tuesday we'll put out what we'll call a price guidance, because we need to give investors a sense of where government can potentially raise the money based on what has been happening in the secondary market. And what I mean by that is where people are buying and selling the same instruments or similar instruments that we are looking to go and issue. Then later on by Wednesday, we would open the auction. Now, the way the auction works is similar to what you call a Dutch auction. So we say, whoever wants to bid for this instrument, please bring your money. You bring your money through certain designated banks in the country. So you go and say, for this security, I want to buy 100 CDs. This is the interest rate I'm looking for. And then the bank will put the auction through to the central bank on your behalf. Now, at the end of the auction process, the government will determine that this is how much we need, but also we don't want to pay a particular price or the other. So there's a cutoff as to how much government will raise. This obviously is in line with how much government is looking to borrow. So government will decide that on this auction, this is how much we want to raise. And then you see, as you highlighted, that the calendar for the past quarter, in some instances, government got well in excess of what they were looking to raise. So therefore, there was no real need to pay a higher price to investors for the 20-year issuance, which was a shelf offering. So I mean, we can go into explaining what a shelf offering is, and I think it's fundamentally important. And I like it when either the media or someone puts out a story which is inaccurate, because what does that present? It presents us with an opportunity to explain, to educate people, which ordinarily probably would not happen. So, I mean, I must say a big thank you to Bloomberg for their story. But the point there is essentially this, that government is very clear in what is looking to borrow. We as professionals, we know exactly what investors would want. When a government comes to us and say a shelf offering, the thinking around that is as follows, that we need certain benchmarks that others can also borrow from. I'll give you an example. In 2016, towards the end of the year, the government for the first time in Ghana issued a 10-year bond, right? And this went quite relatively well. Then come March 2017, they went and tapped into the same instrument again. And then this happened in November. Now, what does that do for the rest of us in the economy? We had ESLA PLC looking to raise money, but because government had set the pace that they could raise money for 10 years, it became easier for investors to understand that ESLA can also do the same. If government has done this, then a corporate could do the same. And it's very important that government sets the pace or the tone for a lot of corporates to follow. Because if you cast your eye across the rest of Africa, a couple of countries I like to compare ourselves to, for instance, Nigeria, and then also maybe Kenya. I mean, Kenya and Nigeria have been issuing 10-year, 15, 20, and even 30-year bonds a lot earlier than we look to do that. I mean, Kenya has close to 8 20-year bonds currently running. You see where I'm coming from. So it's important that certain benchmarks are put there in the market for corporates to be able to go to the market and say, investors, look, 10 years has been done. This is the price that you pay for 10-year money. So if I'm going to raise 10-year money for a corporate, this is the benchmark I'm going to mark myself against. If there's no 10-year benchmark in the market, if there's no 20-year benchmark in the market, it becomes very difficult for investors to get a sense of where to part with their money for. So I think having those shelf offerings are fundamentally important if you want to be able to prepare the ground for the rest of corporate industry in Ghana to be able to follow. And our colleagues in Kenya and Nigeria are well ahead. It's about time we also put ourselves in that place.
Okay. This is the business edition of PM Express. My name is Philip Nanfu. We're taking a quick break. We'll be right back. Right, thanks for staying with us. Before we went to the break, my guest, Samson, and then Sam, were taking us through the whole process when it comes to raising funds for government from the financial markets. Sam gave us some highlights of what government seeks to achieve. And then Samson, I beg your pardon, and then Sam took us through the process as a private player, helping government realize its dream of meeting its funding or financing requirements. But now I want to move into the issue of the cost. And the cost comes up because of we've heard countless times from the finance minister that they want to take cheaper debts to refinance the more expensive debts that were in the system. So it goes to the element of cost when it comes to borrowing. And for some, I'll find out from him the pricing when it comes to the markets. What are investors looking for? What are they feeding into this, and how does it work for a private player trying to help government realize its dream? So I'll start with Samson on this. The medium-term debt management strategy, 2019 to 2022, states very clearly what government seeks to achieve. And if you read section 2, cost and risk characteristics of existing debt portfolio, it just goes to show the fact that government wants to reduce the cost involved. And we've heard the finance minister countless times talking about it. From where you sit, how does a long-term bond help deal with the issue of cost? Because I remember there was a time where, like you said earlier on, our yield curve, some described, was inverted, where we're borrowing more in the short term than in the long term. Now we are trying to normalize the yield curve, so borrow higher in the long term than in the short term. So these long-term debts, from where we are right now, how is it going to really assist us in reducing the cost on borrowing?
Thank you, Philip. I think that in my earlier comment, I tried to lay out the fundamental principles which we have seen, and I'll try to again make it as practical as possible. So if you look at where we are trying to shift borrowing to the long end, I explained that if you see one of the biggest challenge that again we had is that if you borrow a lot short term, and it's like you want to run maybe a business and you borrow like 91 days, maybe 182 days, the amount that you have when you have to pay back is very short. So government goes to borrow 91, and then within like maybe 191 days you have to come back and borrow. So I mean, technically that's what we call the refinancing cost. And the weekly maturities, I mean, when you look at like 2016 and early part of 2017 was in excess of 1 billion. So what typically happens is that you see government coming to the market at the short end under pressure, borrowing very frequently to refinance its existing debt. And the practical effect of that, we have all seen in the economy. You see that interest rates on 91 days and everything is so high. So if a business wants to borrow, aside the fact that you don't even have a benchmark over the long term, you are borrowing short term at very high interest rates. The economy then struggles to breathe. So by our strategy, what you see is that you have reduced that refinance, that pressure on the short term from the 500, like over $1 billion, I think, to now to roughly around 600 million to 500 million. So we have a bit of a breathing space. But in addition to that, because you have actually elongated the borrowing, you have also set for the economy, you know, how the private sector in particular can also borrow over a longer term. So over time, and Sam was trying to explain that over time, what you have to see is that if our banks and some of our corporates can also come to the market with the benchmark that government have established and then borrow over the long term. So if you see, if you even compare it on short-term basis, you realize that our strategy has reduced interest rates on the short end of the curve, and then we try to shift borrowing to the long term and spread it. And over time, if we do that strategy well, and it's well spread out, and you don't have a lot of pressure, especially refinancing pressure, then and the macroeconomy stabilizes over time, and people have confidence. You see that the entire yield curve will be shifting down. So the strategy really is that we have managed to ease that pressure, short-term pressure on government having to look for, and then you have auction pressures and that, and then we shift that to the long term.
Will it be fair to add at this point that will this, if maintained, issuance of a mix of short-term to long-term, particularly in the long term, will it have an effect on the interest payments when it comes to our budgeting? Because you well know it's consuming a lot of the revenue. So will that have a positive effect of reducing what we are spending on interest payments or debt servicing?
Yes, surely it will. It will. In fact, as I explained to you, if you look at if for example you are borrowing at the short end heavily and your short-term interest rate at 25, you know, the pressure that you have in terms of debt servicing and repaying back your mature debt is higher. When you spread it over time, you can't do everything. Remember, 2 years. Like, you have a strategy. Over time, you're going to normalize the yield curve. You're going to reduce the pressure, and then you shift. But the totality of the strategy is that it must be combined with a whole strategy of macro stability, and I think that that also is key.
Let me come to the money man, Sam. The cost of these debts is something we always hear about. It's used for political up and down, a lot of stuff. But from a market perspective, one would argue that 162 million for 20 years, 20.2%. One would say it's fair. Somebody might say it's a bit high. Somebody might say it's low. How do we get to a point and understand what cost or what rate is right for what debt at what given time? I hope my question is, how do we understand? Because sometimes a lot of arguments are thrown about that this is too high, it's expensive, it's cheap. How do we get to a point of understanding where if I take this 162 million for 20 years at 20.2%, I can describe this as cheap, expensive, or something like that?
Yeah, I mean, that is an incredibly difficult question, but it's something we face on a day-to-day basis as part of our jobs. And the 3 banks working with the 2 other non-banks, this is something we struggle with on a day-to-day basis, because our client, who is the government, wants us to raise money for them at the best possible price. Now, what is the best possible price? The best possible price is the price that everybody cumulatively agrees that they would pay for a particular instrument. So, for instance, the investors would be, say, a bank, a pension fund. The pension fund would want to ensure they achieve certain benchmark returns. A bank has the option of either doing a loan to a customer, a retail customer, a corporate customer, or giving the money to government. So there has to be a balance in the mind of each investor at what level do I feel happy enough to part with my money? So there's always a demand-supply situation. What tends to disrupt the equilibrium is if there's either too much money looking for investments or there's too much borrowing requirements by government. So that sort of difficulty of having to meet a point where demand for investments or assets to put your money in meets the supply or the borrowing requirements, it's incredibly important. I mean, in between that, you can have certain complexities. Like what did we see? In late 2016, the 182-day bill was well into the 24%, and it had been there for quite some time. Now, what did we see that do? Over the past few years, that has come down to where we are today, where it's mid-teens. Now, automatically, if you evaluate what government's cost of borrowing was then versus what it is today, they are borrowing a lot cheaper than they did in the past. But they were also borrowing a lot in the short-term side of things. So a lot of the borrowing, which was close to 40%, was being done in the 91 day and then the 182 day. So every so often they had to borrow again. Now what they've tried to do, or what we've helped them as together with the 3 other banks and 2 non-bank houses, is to try and see how we can borrow slightly longer term. So we don't have the need to borrow a significant amount so quickly that people decide to say that I want more for those investments. I mean, today, the short end of government's borrowing is probably less than 17% of their total borrowing. A couple of years ago, it was 40% of it. So what the government has sought to do is to, with our help, of course, is to try and see if we can borrow for slightly longer term, so that we don't have to refinance it and then create a demand that everyone would decide that you'd have to pay more. But anytime you find the market liquidity improving, like banks have a lot of excess liquidity, we have to deploy it somewhere. And then you'd find that that will have a telling effect on where rates are. So it's really an issue of people having money and wanting the best return versus another group of people, in this case our client, the government, looking to borrow money, and where that meets in the middle would determine where the best price is. There is a final angle which I think it's important. And what I've described largely fits the local market. So the Ghanaian institutional investor, the Ghanaian retail investor, but the offshore investor coming into Ghana has to make a judgment call on whether buying Ghana paper for 20 years at 20% makes more sense than buying Tanzania paper 20-year at a particular price. True. And they have to make that call as well based on where the real return, which Samson explained earlier on. So it's really a demand and supply and a return for the risk.
Okay. We are going to get onto the phone lines and speak to our good Professor Bokpin, an economist right here. He's a friend to the multimedia group, to JoyNews, always explaining the issues. And he's going to tell us how we can manage the cost of these debts so as not to burden the Ghanaian economy in the not so far future. So if I have Prof on the line. Hello, Prof.
Yes, good evening.
Hello, Prof. Good evening. How are you?
Viewers.
Yeah, thank you very, very much for joining us. So I'm going to cut right to the chase. Prof, I'm sure you've been following the discussion. With regards to the cost of our debt, we've taken this shelf offering 162 million at 20.2%. Prof, from where you sit as an analyst and an economist, looking at the numbers, what do you make of the cost of our debt and its impact on the Ghanaian economy?
Yes, thank you very much. I think that in the last couple of years, and also drawing inference from the debt management strategy from 2015, where we have seen the rate of debt accumulation coming down, under what the NDC popularly calls smart borrowing. But I think this has taken it to another level in terms of the debt reprofiling, lengthening the maturity profile, which I think they have done. They have made some progress to some extent, but I believe that we could have done better. When you look at the weighted average interest cost of our debt, as at the end of 2018, you can see that coming down, but it's very, very marginal. It's very, very marginal when you look at the weighted interest cost. And then also in terms of the refinancing risk and all of that, that is fine. But I think the rate of progress that we are making is slower than perhaps we could have done. I think that is where the issue is coming from. And if you want to know the real impact of the cost of the debt stock, then you want to go back to the 2016 budget. You want to go back to 2014, 2015, 2017, 2018, and then 2019. And then you realize that when you account for compensation for employees and account for debt, then you realize that we are left with practically nothing left. But then, of course, so there were certain periods in this country where the primary balance was negative. That meant that when you exclude interest payments and you just look at our revenue against our expenditure as interest payments, we were not even in a position to finance that. That meant that we actually to service our debt because we're not generating sufficient cash flow to be able to cover all of that. Then you want to look at that relative to 2019 budget, where we are setting aside approximately 19 billion cedis just to service our debt, just the interest component alone in nominal terms. But if you want to look at the real impact of that also, you want to look at the amount of money we are setting aside for debt servicing relative to the size of the economy, which is more than actually 5%. I think it's about 6%. That is very, very high. But even though, based on the new GDP series, when you look at the debt stock relative to the size of the economy, the new GDP series, it looks like there isn't a lot of problem. But we should just remember that given that we are medium-term performer, based on the World Bank IMF assessment, the potential debt, the policy dependency threshold is more 60%, it's not 70%, it's less than 60%. 54%, 56%, but right now we are doing more than 58%. It is projected to hit about 62% based on the new GDP series by the end of this year. That is a cause for concern, which we all have to address. But then, so look at the recent one that we just did, which was maybe the first of its kind, a consistent with government debt management strategy of lengthening the maturity profile to free up fiscal space and manage the refinancing risk that was present in the debt stock over the period. But we are doing 20%. So if our inflation is 9.4%, the last figure, and we are hopeful that the medium-term inflation target of 8% with a symmetrical rate of 2% is achievable, then doing 20% over 20-year horizon may seem to be too high then, even though it's lower than what we did 4 years ago, what we did 5 years ago, where we were doing 3-year bond, 5-year bond at 25%, 26%. It's lower than that. But then when you compare that against maybe our medium-term target that we all think it is right, we are exiting IMF, and then we have exited IMF. We are saying that the fundamentals are in shape and all of that. Inflation is in single digits and all of that, and yet we are doing 20-year bond at.
So, Prof,
you want to say that is on the high side, but a good way to also look at that is to benchmark ourselves maybe with our peers, or somebody would say, okay, we all did so with the same pool of investors, but then compare that to Rwanda that is doing so maybe at lower that rate, and even though it was oversubscribed, others have raised those dimensions.
Okay, Prof.
So what we are saying is that if we compare it to our past, then it will look like this looks like a good performance. But don't forget that it's not a good benchmark.
Okay, Prof.
So, yes.
So just to wrap up here, so you think we could have done better with the rate on this one we just issued?
Yes, I think that because this is a 20-year bond, the medium-term inflation target we are still looking at 8%. Even if the target band is from 6% to 10%, then we have to just look at the spread. But this is Ghana government security. Perhaps default risk maybe is missed. So then you want to look at it that the spread is just too high.
Okay, Prof.
Which I think going forward we should.
Okay, Prof. I would want to say a big thank you for your time and for joining us here and for sharing this education. That was Professor Godfred Bokpin. He's an economist and sharing some insights on the fact that he believes we could have done better with this rate on this 20-year shelf offering that we just issued. Let's take a quick break. We'll be right back. Right, welcome back from the break. We're just about winding down the conversation, and I want to come to Samson Akligo first on what Prof. Bokpin said, that we could have done better with the rate on this 162 million, 20.2, looking at where our inflation is now and where the target is. What do you have to say to that?
Well, I think I'll just be a bit honest. You see, this particular issuance, when the advisors, the joint book runners went to the market, they came back to government and say that the signal from the market is that they want about 20.5 or like something a bit higher. And government says that, well, no, I want to make sure that I get a better pricing. So we then, because you see, it's a very market-driven process. So they went to do their market sounding. They've even gone to do the price guidance. People bring in their, when they were built, they said they wanted 20.5. That's what the market position was. One of the reasons why, quite frankly, we are even having this conversation is because the government says that, you know, the price clearing that I want should be in line with the original price guidance, which was 20.2. So it is not that we, like, you just do these things in a vacuum. Right. There's an element of like practice that drives it. And the last thing that I think I would also say is that fundamental to also this conversation is that, you see, anytime we mean the government announced that we are going to issue a bond with a shelf offering, what we mean is that we have a particular size in mind. But we are going to register the full size, but we are just going to issue it over time. So that it gets to
so that's what the shelf offering.
That is what the shelf offering means, and that is why it is just very not right for us to say that, you know, the process that we have gone through is very unfair. And I mean, coming from also the market, I think it's important that we have an element whereby people who cover the market cover it in a way that we get a progressive and more dynamic market.
Okay, Sam. 30 seconds for me, please.
I think it's down to what investors think. We are happy to get the best out of investors and the best for government as well. I think the key focus is for us to continue what the local book runners are doing and trying to increase the number of people who have interest in government securities. We have a focus on non-resident Ghanaians who bring close to $2 billion a year worth of dollars into Ghana for consumption. We want to try and say to them, look, bring some more of that money and invest in government securities. And as we get that to increase, it would have a positive impact on price.
Gentlemen, thank you very, very much for your time. That was Samuel Edu, Deputy Managing Director of Fidelity Bank, and Samson Akligo. He's the Acting Director, Financial Sector Division, Ministry of Finance. My name is Philip Nanfu. I want to say a big thank you for keeping us company. You have a good day.